Was having me on to speak on community banking because I worked within the bank, and he, I guess, liked me for some reason and offered me the job here at Rand Capital, so I'm the finance director at Rand Capital, and we focus on helping people find the right type of financing for their deal.
Welcome to the Real Estate Marathon Podcast, your guide in the race to financial freedom through real estate investing and sound financial practices. This podcast is for anyone interested in learning more about real estate investing, personal finances, and a new take on traditional retirement. Now, here are your hosts, Larry Fierro and Mike Moe.
What's going on, everybody? Welcome to the Real Estate Marathon Podcast, your guide on the race to financial freedom through real estate investing and sound financial practices. My name is Mike Moe, one of the hosts of the show. And Mr. Fierro, what a show we got today, my man.
I'm telling you, dude. I'm telling you, this show is very exciting. I'm not even pumped, remember, because I've retired pumped for a little while. I'm very excited about this show, and we're gonna drop some serious knowledge with Will.
Yeah, heck yeah, man. Yeah, remove pumped from your vocabulary and move on to something bigger and better. So, but yeah, no, man, Will's, obviously he's got just a wealth of knowledge and is a really good dude to talk to. So super excited to get into this one. He's the director of finance over at Rand Capital and focuses on providing debt and financing solutions for multifamily properties. So, and not just multifamily as we get into the interview, mobile home parks and things like that as well. But obviously the guy's worked in the financing industry specific to real estate since 2016 and has got a ton of knowledge in that aspect.
Yeah, he's an excellent guest. I had a lot of fun with Will, and I definitely look forward to him coming back the next time too.
Heck yeah, man. Absolutely.
So you want me to jump in here and get everybody warmed up so they don't pull those hammies?
Yeah, let's do it, man.
All right. Today's warm up, balloon payment. A balloon payment is a repayment of the outstanding principal sum made at the end of a loan period, interest only having been paid hitherto. And it actually says hitherto in the definition.
First of all, I need you to define hitherto for me.
In layman's term, it means up to this point.
Yes, absolutely. All right, yeah, so we got into it a little bit with Will, but in commercial financing is compared to residential financing. A lot of times the term is going to be different than the amortization. So you might have a 5, 7, or 10-year term and a 30-year amortization or 25-year amortization. And the term, at the end of that term, is when that loan is due, that note is due. So that's that balloon payment. And the first time that I got into the commercial industry or commercial financing, it was kind of a weird concept because you don't even think about it in residential for the most part when you're buying, your singles, duplex, tris, and quads or your primary residence. And it seems a little concerning, right? That full balance due at 5, 7, or 10 years, but it's quite normal in the commercial financing. It just means you got to plan your exit strategy accordingly with that, that balloon payment.
Make sure that your repositioning is done well in advance of the balloon payment, because that usually helps with the refinance.
Yeah, you want to make sure your repositioning is done. You want to make sure that if you're going to refinance or if you're going to sell, you have enough time to do so before that balloon payment comes up. And also make sure you want to time, not to time the market, but make sure that you're getting a term that matches, where we are in the cycle, right? So you don't want to potentially get a term where it's 3 years or 4 years. And in that time, and when that comes due, we're at a bad point in the market and you're selling at a lower valuation. So definitely some things to think about when you got that balloon payment.
A little planning makes it easier. So
yep, absolutely.
Well, I'm excited to jump into this interview. So you want to go ahead and let's do this?
Yeah, man, I'm pumped. Let's do it.
Oh, too far.
All right, Mr. Will Coleman, welcome to the Real Estate Marathon Podcast, man. How you doing?
Doing well. Thanks for having me, guys.
I'm excited about this one, man. You and I met, about a year ago now?
Yeah, almost exactly a year, yeah.
Yeah, we coincidentally enough, we shared a cab or an Uber to the airport, and both of our planes got delayed, so we ended up sharing a beer and getting a beer and some dinner there, huh?
Yeah, what was that, Applebee's?
Yeah, it was.
I think it's got like 3 hours at Applebee's or something.
Yeah, not the best choice, but when you got a airport that is a small airport, you're limited. Your choices are limited, but
any port in a storm, right?
Yeah, right.
I think I was trying to convince Mike to go for a second or third beer, but he held off a little bit.
He's a little reserved.
Yeah, just a little bit. I wasn't letting loose in the airport, but no, man, I'm excited. Like, I was impressed with your story back then, and it's been a year, and you've made some big moves. So I'm excited to dive in to hear what you've been doing in the last year or two as well. So
yeah, exciting.
Before we dive in, so we're going to cover your background. We're going to cover kind of what got you into real estate and what you're doing. And then we're going to give the listeners kind of a 101 on commercial financing, because that is, as they'll know once you kind of give your story, that's what you do now. So can you start off by just giving the listeners kind of a background overview of who you are and what you've been up to?
Sure. Yeah. So it all kind of started for me in college. I wasn't a huge fan of college. I played sports in college, and I basically say I majored in soccer, even though I got my undergrad in economics, but I decided that I wanted to get into the real world sooner. So I graduated. I took a bunch of summer classes and graduated early. And right out of college, I was a big fan of Bigger Pockets, did the whole house hack thing. So bought a single family. I think I put like $7,000 into it, and then had my parents sign on the loan. House hacked, rented out the other 3 bedrooms to college kids. And at the time, I knew I wanted to get into multifamily eventually, and so I started working as a leasing agent for Greystar, which is the largest property management company in the U.S. So I was house hacking while working as a leasing agent, just because I knew I wanted to cover my bases. And then once I worked as a leasing agent for 2 years, I felt like I understood the operations well enough. And I kind of was figuring out that I was a numbers oriented person, and I really enjoyed the kind of analytics of it. So in my eyes, you can either go into acquisitions or lending in that field. And I saw lending as kind of the lifeblood of real estate. If you look at every property, it has a loan on it, or at least 99.9% of them do. So if the lending stops, it's kind of like your blood system. Your blood, the whole system dies. So I started looking for a job in commercial lending, got a job at a commercial real estate bank in Texas. And then while I worked there as an analyst, kind of learning the lending side of it, I bought 2 more single families. So I had a portfolio of 3 single families, and then joined the Jake and Gino program as a student in order to start learning the multifamily side. And as I was a student, Gino was having me on to speak on community banking because I worked within the bank, and he, I guess, liked me for some reason and offered me the job here at Rand Capital, so I'm the finance director at Rand Capital, and we focus on helping people find the right type of financing for their deal, whether they're looking for the first deal or they're a veteran in the game. We'll specialize in non-recourse debt on apartments, so specifically Fannie and Freddie, but we do have connections with bridge debt, private debt, CMBS, life insurance companies, as well as some regional banks in the area. So we try and be kind of a one-stop shop for financing of all aspects for commercial real estate, but really specialize in apartments.
Nice, man. So it sounded like you wanted to get into real estate from the beginning, getting, the job as a leasing agent, and then from the lending side. Why did you choose real estate?
I think I was lucky with my dad was kind of so he works in insurance and he hates his job, and he always insured investors. And so he would always say, like, man, you should get into real estate. Like, I remember as a kid, we were on vacation one time and we walked past a large hotel that was being built. And I remember my dad saying, like, man, you should get into commercial real estate one day. And that's when I was like 12 years old. So nice. I think that just kind of always stuck with me. And so, I've always believed in building a foundation in real estate. And then once I build that foundation of income, then kind of going into more things that I would consider my passions and things like that.
Nice. That's awesome.
What was when you first started out, what did you consider your biggest hurdle when first starting?
Probably just the education and knowing, because I feel like I'm a big believer in you can learn so much in a book, and then there's certain things you kind of have to learn by experience. Being relatively younger, it is hard to learn through experience at some stages. So that was probably my biggest hurdle. Just the reading books, talking to people, working in the space. It takes time. I think the best piece of advice I ever got was get a job that makes you a better investor. And that's what made me decide to go from leasing agent to analyst at a bank. And so I think that's kind of how I overcame that hurdle. But I'm still overcoming that hurdle every day.
That is great advice. I love that. I'm gonna start handing that advice out, and I will definitely give you credit for every time I hand it out.
Feel free to take credit if you need.
Yeah, getting a job that makes you a better investor. That's awesome, man. Because I think a lot of people try doing this part-time, and it's tough to do. It's a tough thing to do part-time, not just from the time commitment, but also just from the context switching. You know, if you're doing your full-time gig and then you're doing the real estate, it's tough to make some of those transitions from just a mental standpoint, right? So yeah, getting a job in the industry, it would definitely be huge. So, all right, man. So I want to transition a little bit into commercial real estate 101. So like we said before we kind of hit that record button, we've talked a lot about financing kind of 1 through 4s. And I think people are a little bit more familiar with that because it's very similar to financing the primary residence, which a lot of people have done. But it changes a ton once you get into that commercial side on 5 units and up, right? So can you overview some of the biggest differences between financing that either that primary residence or that 1 through 4 and 5 and up?
Sure. So the two main differences would be on residential properties. They're really going to put a lot of weight on you as the buyer. So they'll look at your personal financial statement, your tax returns. Really all the underwriting they'll do on the property is kind of the basics, the appraisal, the inspection. They're probably not going to do much of a marketing analysis or anything like that. So you need to qualify. When I was buying my single family, they would look at kind of your debt to income ratio. That's a big player in buying a single family. But when you go to the larger assets, they'll put a lot more weight on the property itself. So they'll look at the occupancy, they'll look at the income, they'll look at the DSCR, they'll look at the property expenses, they'll look at the market analysis. So from a banking perspective, the big thing they'll look at in terms of analyzing is they'll look at, for single family, they'll look at a lot you personally, and for the larger stuff, they'll put a lot of weight on the property itself. Now, when it comes to the difference in terms, commercial loans will be much different than a personal loan. Commercial loans, the big differences are going to be the terms, the amortization. So a personal residence, generally your amortization will align with your term. So it's a 30-year term, 30-year amortization, and basically meaning you have 30 years to pay it off. For a commercial loan with a community bank, it's generally going to be 25-year amortization. And think of amortization as how long you have to pay something back. So if I give you $10 and you say you have 10 years to pay that back, it's $1 a year. But if I give you $10 and say you have 5 years to pay it back, you have to pay me $2 a year. So your debt payment is going to be higher with a shorter amortization. So with a community bank on a commercial asset, you're looking at 20 to 25-year amortization. But the main difference between the residential and the commercial will be the term. Even though you have a 25-year amortization, on a commercial loan, you're going to have a 5, 7, or 10-year term, meaning technically that loan is due at the end of the 5, 7, or 10-year term. What you do is you'll either refi or sell at the end of the term. And, a lot of times you can do a fixed rate for the 5, 7, 10-year term, or you can do a variable rate or however you want to set it up. But that's probably the biggest difference in terms of a lender and how they look at it. They're going to look at you pretty strong on your personal financials for the residential, and then a lot more weight will be put on the property for the commercial. And then for the terms, the biggest difference is going to be the amortization and then the shorter term on the commercial loan. Does that make sense?
Yeah, for sure. And that was a big shocker for me when I first started looking at commercial, because when you're primary and, buying a smaller property, you just think that your amortization, your terms are the same all the time. And that's how it always is, right? So to hear that, you might have a 25 or 30 year AM, but it's technically due in 5 or 7 or 10 years. It's kind of a shocker when you start looking into it. So
yeah, cool. It's kind of confusing at first because you don't really understand the difference between amortization and term. And it's important in commercial real estate because you need to align your term with where you are in the market cycle. So if you're at the top of the market cycle, you don't want to get a short term. You don't want to get a 3 to 5 year term, because when your loan comes due, you're either going to have to refinance it or sell. So if you're at a declining market cycle with a short term loan, you're going to put yourself in trouble. So that's why it's important when you're getting a commercial loan is to factor in where you are with the market cycle as well as your business plan to make sure you're structuring the term correctly so it aligns with your business plan and the market cycle as well.
Yeah, it's a really good point, man. Because I think with the smaller properties, again, you can just say 30 years, so I can hold it forever if I want to, and I'm not forced to sell at any point in time. But with these loans, you are basically forced to either to do something, either sell or refinance. And if you're in a bad spot in the market at that time, you want to make sure you're super clear about your exit strategy and when you're getting out of that property, and make sure your financing aligns with it. So that's a super, super important point there.
Yeah, absolutely.
Yeah, I did a lot of owner financing with something similar to that. We did a 30-year amortization with a 5-year balloon payment. So we kind of took advantage of that a little bit to get some seasoning. Now, between the two types, the residential and the commercial, if somebody were coming to you, which type is easier to get financing for? Is it commercial or residential?
That's a tough question. I guess it's probably a bit easier on the residential just because you need less of a strong balance sheet. But if you have, put it this way, if you have poor credit, not great income, like for example, a lot of full-time real estate investors don't have a full-time job. So in that situation, it may be slightly more difficult to get a loan on at the sixplex, or because a community bank they're going to look at the sixplex, especially if it's a non-performing sixplex. They're going to look at it and say that the asset's not performing not creating a lot of income, but then also the borrower doesn't have a full-time job. He doesn't have a consistent amount of income. Whereas if you're going to buy your personal or 1 to 2 unit and you don't have a job, but you've got a decent amount of capital, the bank on the residential is not going to care. So it kind of depends on the deal and the setup, but for the most part, it's probably easier to get a loan on a residential asset if you've got a job, decent credit. And then on the commercial, it's because they'll put more weight on the property. As long as it's a decent property and you have the financial backing to get that loan, then that might be easier. But for the most part, it is a little bit more difficult to have the balance sheet necessary for a larger asset. So in that sense, I would say it's a little bit more difficult, but it just kind of depends on your situation.
One of the things I'm running into, right, that I've found is with commercial real estate or just rental properties in general, you get so many deductions that it shows that you don't really make any income on your income tax, and wanted to try and figure out and kind of grill you a little bit on how people answer that when they're going for financing. If you come in with a commercial or a corporate tax return that's got zero income and actually a negative. And I was kind of curious on how that was addressed.
So I can answer that quickly. Basically, a community bank that lends on smaller, so we'll stick with the sixplex. Because it is recourse debt, meaning you are personally liable for the debt, they will look at your personal tax return and your personal financial statement. When a bank underwrites a tax return, though, they'll look at your income and they'll take out the depreciation expenses. They'll take out a lot of the stuff that makes your income look negative. So each bank might underwrite it slightly differently, but what the bank will do their best to do is we call it spread your tax return. So they'll go to your tax return and they'll input it into our software. And when they do that, they'll take out any loss carryovers, any depreciation expense, any interest expense, anything like that. So they'll try their best to get a feel of what your actual cash income was for the year. But each bank might underwrite it slightly differently. But for the most part, they'll try and look at it in that way.
So you can still take advantage of those losses and not have it impact your lending ability very much.
Exactly.
Nice. All right, man. I got one more, and it's a two-parter before we transition into how we start looking at maybe financing our first deal, our first larger deal. Maybe we'll use that sixplex as a good example. But lending or the financing, how intimate does somebody need to be an investor learning this and starting to need to be with financing and the terms? And obviously it's got a huge impact on the deal and the performance, but how deep of a level of knowledge do they need on that? And how do they get that? Like, do they need to go back and get an MBA in corporate finance or real estate finance? Or like, are there some resources that they can get that level of knowledge that you'd recommend?
So in terms of how intimate you need to be, you don't need to be crazy intimate, but you do need to understand the basics of it. You need to understand interest rate, term, amortization. You need to understand leverage, how much leverage is going to be necessary to put down. And I'll give you an example why it's important. Is because if you're going to, let's stick with the sixplex, and you're going to buy it, and your plan is to go with community bank financing on the front end, and you're going to then refinance it 3 to 5 years later. If you're going to input it into your model, because a lot of people will try and estimate what the returns are going to be, you need to know where your interest rate's going to be. You need to know where your leverage is going to be. You need to understand how you want to structure your term so that you can plan when you're going to refinance. You need to know when the prepayment penalty is. You need to understand what your amortization is, because if you're inputting 30-year amortization into the model, when you're probably going to go with community bank that's going to do 25-year amortization, that's going to affect your return. So I would say you need to understand the high-level basics in order to at least purchase a commercial real estate asset. I'm sure people have been successful without knowing, especially with the compression cap rates we've seen in the last 10 years or so. And then in terms of how to educate yourself on that, I mean, YouTube is a great resource. I would literally YouTube, what is this? Or like, how are interest rates? How do banks calculate interest rates? So YouTube is a great resource. This is a little high level, but there's a textbook by Peter Lindemann. It's real estate risk and opportunities, something like that. I don't know exactly, but that's a great textbook. The difficult part about financing is it does change constantly. So like rates are changing constantly, leverage is changing constantly. So the best way is to contact multiple lenders and just build a good relationship with a lender or a broker, because once you understand the high level stuff, then there's a lot of intricacies behind that move constantly. So, I would say YouTube, any books you can find, and then really the best thing is going to be to be in the ear of a lender pretty frequently.
And let's jump into financing our first deal then. I'm a newbie in the multifamily, the larger commercial multifamily, and I'm ready to start looking at my first project to purchase. What on my side do I have to prepare? Where should I start getting ready to finance?
So we can do a little what's it called? I don't even know what it's called.
Hypotheticals?
Well, I was going to say, let's pretend that you're actually looking for financing and I'm the lender, and I can kind of
role playing.
Yeah, role playing. I guess that's the right word I was looking for. So let's say you called me and you're looking for a loan on a sixplex.
Yes.
And let's just see where it goes.
All right. Hi, Will. This is Larry calling from New York. I've got a sixplex that I'm looking at. I've got it under contract right now, and I'm looking to try and secure financing for it. And I was calling to see where I would begin that process with you.
Sweet. So Larry, what's the purchase price on the sixplex?
The sixplex is $1.2 million.
1.2 million?
Yes.
Okay. And is it occupied or is it distressed? Would you say?
It is 100% occupied right now, but there is a value add component because it has not been remodeled in 15 years, and it's about $300 below market rents.
Okay. So there's some plus side there. So that's good. Have you filled out your personal financial statement? And the reason I say that is because generally banks will like to see a personal financial statement, meaning your assets minus your liabilities, which would equal your net worth. They like to see a net worth that's at least close to the loan amount. Community banks, your local Wells Fargo, Citibank, things like that, they'll be less strict on that. But if your purchase price is 1.2, generally your leverage is around 75% of that. So let's just keep it easy. Let's say that's 900,000. Generally, they'll like to see a net worth at close to 900,000. It doesn't have to be quite exact. So have you filled out a personal financial statement yet?
I have not. It's my company is a corporation, so I was mainly concentrating on getting that's numbers around, but I was unaware of the fact that I needed my personal, so I will have to start getting that in line.
Yeah. So if you're going with a community bank, they will require your personal financial statement. However, agency, which is Fannie or Freddie, are you familiar with Fannie or Freddie?
A little bit. Okay. I don't have a lot of experience with them.
Okay. So Fannie and Freddie are basically government-sponsored entities. They provide some of the best financing for multifamily. So the benefits between agency and community bank is basically that Fannie and Freddie will offer 30-year amortization. It's non-recourse, meaning you're not personally liable. It's very low interest rates, and you can do fixed interest rates for 10, 12 years. So a lot of times people will prefer to go agency, but when you're starting out, community bank is a little bit better option because they're a little bit more flexible. Agency really likes to see more experience. They like to see that, like, so if you're buying a sixplex, they like to see that you've owned a sixplex previously. They like to see that previous experience. So for here, I think we'll go with a community bank. And because it is recourse debt, they're going to require to see your personal financial statement and your tax returns. So before we present this to a lender, I think it'd be ideal to kind of create your personal financial statement. And I have a document that I can send you, as well as your tax return. That way the lender can see your net worth. They can see how much liquidity you have in terms of cash, stocks. They can see your current investments, and then they can see your tax return, your income over the last 3 years.
Okay, so you said the community bank won't put as much emphasis on my lack of experience since this is my first sixplex.
Correct. Yes, they'll still like to see. I mean, it'll help, right? I mean, if you're starting out, it's not required for a community bank. They'll still like, if you have it, it's better. But for the most part, if you have, decent work experience, whether in your job or single family, and if you have a net worth and liquidity standpoint that they feel comfortable with, then you'll be much more willing to be flexible with you on the sixplex.
And one other question I had for you as far as the experience, I have 10 duplexes that we manage ourselves. Does that count towards commercial, even though it's really considered a residential property, but I do manage, those properties?
Are they all right next to each other, or are they pretty spread out?
They're in the same city, but they are spread out somewhat. So
that would probably qualify for agency. So because you have 10 units that you self-manage, a sixplex would be considered within kind of similar experience.
Okay.
So it may make sense to kind of put a package together for a community bank and an agency to see who offers the best term. So I think potentially you could go both routes with this one.
Oh, good. And okay. That was the question I had. If you could send that form over, it's Larry@realestatemarathonpodcast.com.
Shameless plug. I love it.
Gratuitous plug. I like.
Dude, that was awesome. All right. So
I don't know.
Yeah, no, that was good. So I want to break that down for a minute. So you need some basic information about the deal when you're calling your lender, right? You need to obviously know the purchase price, occupancy. You need to have some of your own personal finance, your personal finance house in order, and you need to have some of those documents at the ready, right? So personal financial statement, balance sheet, tax returns, things like that. Is there a preferred method of sending that, or do you just wait until they figure out how they want it? Because I think some banks prefer like different formats of your personal financial statement, or how do you already have to have that prepared and ready to send, or do you wait until they figure out how they want it?
So community banks, they will not require a specific type of personal financial statement. I guess maybe some will, but the majority of them won't. The biggest thing is just having it accurate, well filled out, and signed. Almost none of them are any of those things. So if you've got it accurately filled out and signed, I mean, you're ahead of the game. Agency though, so Fannie and Freddie, which again, that's more what we specialize in, they will require a specific type. Here at Rand Capital, we have a personal financial statement that is branded. So if your listeners want, email me at will@randcre.com. and I can shoot over that type of personal financial statement. I even have links in the personal financial statement that talk about how to fill out certain sections. So community bank, no, as long as it's accurate and signed. Fannie and Freddie, it will need to be a certain type, yes.
Nice. I think you'll be getting an email from Larry@realestatemarathonpodcast.com.
You will be, because I've been meaning to call you, and we actually just did the initial call. So that was a great role play based on reality. So thank you.
Perfect. There you go. Glad that was you. I was kind of taking a risk there.
Yeah.
No, that was good.
I will be emailing you for that form.
So I want to pick apart one thing on that role play as well. If I have a deal under contract, I'm assuming that it shouldn't be the first time I'm talking to my lender. Is that accurate? Or how do you build that relationship? At what point in time do you build that relationship with those lenders that can help you out in those larger properties?
Yeah, I mean, preferably you would have a conversation with the lender prior to. The difficult part is getting a lender to take you seriously before you have it under contract, because
Gotcha.
I mean, we get 10 to 15 people reach out a week that are mostly blowing smoke, or that they're looking at a deal and they're like, oh yeah, we're making the offer tomorrow, and we've got a partner who's got the net worth that can match, and sometimes the lenders are trying not to waste their time.
Yeah.
So the way to mitigate that is just really be prepared and put in the work, like really underwrite the property. If you can, prepare your personal financial statement, have as much details ready. And so what I like to do is schedule a 15-minute call, and just kind of the exact same call that me and Larry just had, and kind of walk through the deal. Because a lender can tell pretty quickly if they're legit or not. And then after that 15-minute call, I will then send a document request over to that borrower, and then they'll send over the information. So the personal financial statement, the details on the property, and then we'll underwrite it ourselves and then give you feedback within 48 hours that you can use to make your offer. That being said, it is possible to have, I've had people approach me with a deal under contract and we can underwrite it and close in time. But I would just say, maybe a week before you decide to submit your offer, call your lender or call me, and we can kind of just quickly high level discuss the deal. And I can tell you if you're on or pretty far off in terms of your financing assumptions.
Yeah, because a lot of that can make a huge difference in your deal, right? You might be, if you're missing the interest rate or the amortization or really any one of those, the reserves, that could totally bust your deal. So it's good to have some of that ahead of time before you make your offer. You don't know, you make an offer and then have to take it back just based on the fact that you missed your numbers. Yeah.
And I found that most people are too conservative on financing. So they're underwriting maybe not on the leverage. Maybe they're a little bit over liberal on the leverage, but in terms of their interest rate and a lot of times the reserves or the amortization, they're too conservative. So most of the time when I look at people's underwriting, I'm able to say, hey, you can actually lower this and that'll help your offer make a little bit better. So you can either offer more on the property or, maybe less due diligence. There's ways we can help out in terms of tweaking a few things.
Yeah, that's awesome.
That's important too, because like you said, when I'm underwriting a deal, I have a tendency to be a little bit super cautious because it's the first deal, and it's the numbers are a lot larger than the duplexes that I'm used to working with. So that's good to have a professional opinion on it after the fact.
And those minor tweaks make a big difference. I think I told this story last time or a couple episodes ago, but we missed out on a 10-unit property by $2,000. Wow. About 3 months ago, and we didn't even get a counter. So that one of those minor changes in the underwriting could definitely make your offer a little bit more competitive and get you in that final round of offers. So
yeah, no, absolutely. I just to give you an example, like rates for Freddie Mac SBL dropped 15 bips yesterday. So anyone who's underwriting, let's say they're being conservative and they're underwriting at 4%, but when they realistically could be getting 3.75 or so, and now they're closer to 3.55 and they're still using the 4%. So a lot of times they'll say make sure it still works at 4%, but then see what the returns look like at 3.55 to kind of see how high you can go up on your offer if you need to, because realistically you can get that rate, but it makes sense to be conservative and, be closer to that 4% in your initial underwriting.
Nice. That's awesome. Cool, man. Larry, where should we go next, man? Should we just get some random questions from Will on Rand Capital?
Yeah, I want to go into Rand Capital a little bit because I have a couple of questions. And one of them was, do you guys finance mobile home parks?
We do. I love mobile home parks. I'm very, very bullish on mobile home parks. We've actually got a deal right now that we're planning to close at the end of July. It's a 53 pad mobile home park here in Knoxville, Tennessee, and we've got great terms on it. It's $944,000 loan amount. The rate is 3.4, but just kind of right around 3.4. We're going to be able to close in probably 45 days. What else am I missing? 30-year amortization, non-recourse, 10-year term, fixed rate. So it's a cash out. So the borrower is he's going to pull out a decent amount and go buy another property. So we do finance mobile home parks. That's probably That's probably my favorite asset class right now, aside from multifamily, obviously.
Give me the 30-second overview on why you like mobile home parks.
I'd say mobile home parks are where multifamily was 5 years ago, where they're still trading at 8 to 12 caps. There's more and more capital that was pushed towards multifamily that wanted those types of cap rates, and they're no longer seeing that in multifamily. It's really almost 4 to 5% cap rates, and a lot of the multifamily stuff in certain markets, obviously. But they're seeing the cash flow returns, exceeding 10% cash on cash. They're seeing the cap rates being very strong. There's a lot of lack of efficiencies in mobile home parks, so it's still much more mom and pop owners, people that may not quite understand how much worth their property is worth. So if you can get a direct to seller property on mobile home parks, there's just more opportunity to be had in mobile home parks, in my opinion. And they have the factor of a lack of supply. So it's very difficult to build mobile home parks. Each year there's going to be more and more people looking for it, meaning not many mobile home parks being built. So I think cap rates are just going to continue to compress. So if you can buy 3 or 4 parks right now, hold on to it, I think your asset appreciation is going to be pretty sizable, as long as no legalities change or anything like that.
Nice. That's awesome.
Now, Rand Capital, for kind of an overview, you want to give us a little bit of an overview of Rand Capital, and is it a one-stop shop for all things financing for the real estate industry?
We try to be, yeah. So essentially what we do is we're in the market every day talking to lenders, whether it's bridge lenders, whether it's agency, whether it's banks, whether it's CMBS, private, all kinds of different lending options, construction. So we're constantly talking with these lenders, seeing where rates are at, seeing where leverage is at, seeing what they feel comfortable lending on, what they don't. So the idea is, anyone who's looking to purchase pretty much anything within commercial real estate to contact us. We'll look at the deal, we'll underwrite it, we'll go shop it to 3 or 4 lenders that fit that asset class, and then we'll go back to you and say, here's what we found. There's a couple lenders that are in these rates. We've worked with these couple lenders before. We feel very confident in their ability to execute. We do specialize in multifamily, but we're really trying to branch out. It's kind of one of my initiatives to really be a mobile home park, kind of one of the first brokerages to really step into the mobile home park space. We do specialize in the multifamily and in the mobile home parks, but we'll also do, industrial, self-storage, the scattered site portfolios. What else is there? I mean, haven't done any hotels, but kind of all over the place in terms of what we have access to, but we'll definitely specialize kind of in that multifamily space. And our goal is really just almost to be a consultant to you, so you can, on the front end, you're underwriting a deal, we can show you what we're seeing in rates, what we're seeing in leverage, how long things are taking to close, et cetera. So we're kind of being a consultant to your real estate business and then help you achieve the right type of financing on your deal. Awesome,
man. All right, I got one more for you. I couldn't not ask you a question around our current climate, man, and the Rona, the COVID stuff we got going on now. And in your opinion, is this a good time for somebody who is looking to get into their, the first multifamily, the first larger property to do it? Or is this a time for them to play it safe, sit on the sidelines and kind of see how this plays out in the economy and in the space? Or what's your thoughts on where we're at right now and I knew be getting into it?
So I'll answer and then I want to ask y'all's thoughts as well. So get ready. I would preface it with it. I don't know. I think anyone who pretends to know, the smartest people I listen to, Howard Marks, Ray Dalio, Warren Buffett, they all kind of preface it, Sam Zell, they all kind of preface everything they say with, no one knows where the market is headed. I mean, the stock market's a perfect example. It crashed. And I remember talking to people saying, this is the Great Depression. Don't buy stocks. It's going to take 10 years for them to get back. And these are, very experienced people. And then, a month later, it's higher than it was before. So I would just preface it with that no one really knows exactly where the market is going to go. But in my eyes, it's a great time to get into real estate. I think, although we haven't seen it yet, we're still in kind of the price discovery phase where sellers haven't been affected in terms of the rental collections. So sellers still want to sell at the same price that they could in January, and buyers, with the increase of risk in the market, buyers want to buy at a 15-20% discount. I mean, that being said, we've got the unemployment rate's now at 10%, which that's, I don't know the exact number, 8 to 10 million people. I don't know exactly what it is, but it's a significant amount of people that are not working, meaning incomes have gone down, which means that spending is going to go down. And as spending goes down, incomes and asset values have to drop at some level. So there, in my eyes, there has to be some level of decrease in value for multifamily. And I think if you don't get in now, the asset values are just going to shoot back up 4 to 5 years down the road. So, I mean, buy fear, sell greed. Anytime the market crashes, you lean into it because you're really betting on the American economy. Like, is this the end of the U.S. economy, or will we get better? And I would bet on the U.S. economy. That being said, no one knows what's going to happen. But I'll swing it back to you. What do you guys think?
Well, I can tell you, me personally, I was interviewed for owner financing on Adam Adams' podcast, a creative real estate podcast, about a month and a half ago. And my prediction was that we were going to start seeing an outflux of cities into more residential and rural areas because of the coronavirus. And it just released yesterday after they started saying that that's what's going to happen. So it kind of looked like I was jumping on the bandwagon, but I was actually a month and a half ago. But, for me, it's just people are more afraid recently of any population centers because of the coronavirus. And I think you're going to start seeing more projects happening in residential areas and people leaving cities for more rural areas where the population isn't as dense. That was my prediction, and that's where I've been kind of concentrating now. That is just my gut feeling on it, and hopefully the coronavirus goes away and we get back to life as normal. But, I think at this point we've got some people that are still fairly afraid of being anywhere near a population center.
Mm-hmm. Yeah, I think to your point, man, you're betting on the U.S. economy. And I think even though nobody knows, I think the majority of people don't think this is the end of the U.S. economy. So, I think it's still a good time to get in, but I think it's a terrible time to get in undercapitalized and not knowing your numbers back to front. So I think at least in my market that I'm looking at, we're seeing the same things. Sellers they're not hurt right now. They're not hurting. The rent collections are good. So they're not discounting their properties at all. And if anything, prices have kind of gotten up because of transaction volume has gone down. People who are thinking about selling have not. So there's fewer properties out there, and there's just as many investors out there looking to scoop them up. But to your point, with the risk that we don't know, the uncertainty, where a lot of people are factoring in that into their underwriting, and there's such a gap between the seller expectations and what the purchaser or the buyer is looking at. So I don't think it's a bad time to get in. I think nobody knows what the impact is, especially on these median incomes of $25,000 to $35,000 a year, which is primarily hospitality and the service industry that are obviously hit when these whole industries get shut down, right? Those are huge. But I think it's not a bad time to get in. Just don't get in undercapitalized, because if you have to withstand a 8 to 12 months or 16 months of poorer performance, I think you'll be paid off in that longer run, but you have to be able to withstand that.
Yeah. And Howard Marks kind of talks about why cycles happen. And a big part of it is, as asset values are increasing, income is increasing, people lax their underwriting. They go into things undercapitalized, and they can because the asset values keep increasing. And then eventually you kind of get to the top, and maybe Corona happens or something happens, and then you start going down, and the people that lax on their underwriting and went undercapitalized lose their deals. And the people that start buying as it's going down, then they're doing exactly what you're saying. There's pressure on them, so they have to do it correctly. And then that causes organic growth for the cycle to go back up. And it just kind of repeats itself. So I think in a down cycle, people are forced to do exactly what you said. And that's what causes organic growth.
Yeah. And they're forced to somewhat from the lending side, right? Like you could have gotten away with things, 12 months ago that the lenders are not. They're looking at that underwriting and they're correcting a lot of investors, I'd imagine. Is that what you're seeing from your end?
Yeah, absolutely. I mean, leverage is being pulled back. People that were able to get financing previously probably, may not be this time. So I don't know if you'd say we're correcting investors, but we're much more conservative on leverage and who we lend to. And that causes the people that are, being lax on their underwriting and are not capitalized enough to receive no financing at all.
Yeah. Nice.
Or make it much more difficult. Yeah.
Cool. All right, Larry, you got anything else for Mr. Coleman here?
No, I'm getting writer's cramp from my notes. So, I'll be reaching out to email you. I want to make you one of my best friends in the real estate area. So
that'd be awesome. I'll shoot you over that. I'll shoot you over that financial statement right after this.
I appreciate that.
Yeah.
So can you give the listeners, maybe if people want to reach out to you, where can they go to connect with you and learn more and get some help with their financing?
Sure. So my email is Will, WILL at RandCRE.com. You can check out our website, randcapllc.com. So RANDCAPLLC.com. You can see the terms for different financing options on our website, as well as we have resources about, different index rates and articles that we post. The most recent one was when is the best time to refinance, which also could be a good return podcast topic if you guys are interested.
There you go. Absolutely.
So, email and website, that's the best two spots.
You didn't hear that you were coming back for the next 4 weeks in a row because we didn't even scratch the surface yet, my friend.
I love it.
Awesome. Yeah. So guys, reach out to Will for all your financing needs. And man, I got to thank you for coming on and talking to us about financing and giving the listeners a little taste of what you know, man. I think this is going to be super valuable for people looking to get into this space and finance their first property or, 10th property even.
Yeah, thanks, guys. This is actually my first podcast, so thanks for having me on.
You did
there we go.
Job.
We got to be the first. We're honored. So, but nice. No, thank you, man. It's awesome.
Thanks, guys. Yeah,
thanks.
All right, everybody. That was Mr. Will Coleman, Director of Finance over at Rand Capital, and as expected, Larry, he did not disappoint.
He did not. And I got to tell you, my favorite part of the whole interview was the call that we did, the role-playing call. And that was a lot of fun. And he actually helped me because that was a call that I was planning on having with him anyway.
Yeah, exactly. Right? That's awesome. Yeah. And it's good to hear that because if you kind of understand how the conversations can sometimes go, it can help you feel a little bit more comfortable when you're making that call yourself. So
for you folks out there, that was actually my call with Will. So he answered the questions and I kind of got a little selfish with the podcast. So I apologize for that, but I hope everybody got value out of it. I know I did.
Yeah, absolutely. Yep.
So call to action, my man. What do we think?
Dude. So it's just the call to action is if you are unfamiliar with some of these terms, if you're unfamiliar with some of these concepts, re-educate yourself. Go out there and learn the commercial financing and the financing that relates to the deals that you are trying to do. Because as we discussed with Will, it's not required of you. It's not necessary to get a master's degree in finance, but you do need to understand these terms. You need to understand the financing and how it impacts your deal. And you also need to be able to speak in a way that when you're talking to lenders, when you're talking to brokers, you can discuss the financing in a way that makes you not come off as a complete noob, right? So the call to action is as simple as that. Go get educated. If you're not comfortable with financing, you need to at least have a certain level of familiarity with it because obviously it has a huge impact on your deal.
It's very important too, because when you get off the phone, if you don't understand the terminology, that broker or that real estate agent, they're going to lose your number.
Yeah.
They're going to be like, oh, he doesn't have any clue what he's doing. So, and I'm too busy to train him. I'm too busy. If he doesn't want to, or they don't want to take their own initiative to learn the terms, then I'm not going to be the one training them because I'm just too busy. And most brokers and most real estate agents are so busy that it's difficult for them to call you back. And when they do, you got to get right to the point. You got to tell them.
Even to some extent, from a lender's perspective, the lenders are so crazy busy now with where rates are at and where the industry's at that you have to show that you are educated and that you know what you're doing and that you're not just kicking tires when you're asking for term sheets and when you're asking for them to discuss, what options might be available for certain deals in order for them to take you seriously as well.
Yeah, so make sure you're educated, sound professional, and impress them. And
yeah,
you won't
absolutely.
Have any problems.
Yep. And you obviously got to know how it impacts your deal because it's a big lever for a lot of these deals. And, in some cases it can make or break it. So,
you got to be prepared.
Yep. Cool, man.
Well, that's everything I've got. How about yourself, my friend?
That's it. So thank you guys for tuning into another episode of the Real Estate Marathon Podcast. We'll see you next time.
Take care.
Thanks for listening to the Real Estate Marathon Podcast. If you found value in any of the content from this show, consider supporting us in the following ways. Subscribe to the Real Estate Marathon Podcast. Leave a rating and review. Continue the conversation with like-minded individuals on social media by heading over to the Real Estate Marathon Podcast Facebook group, or follow us on Instagram and Twitter at Real Estate Marathon Podcast.